You might struggle with consistency, with your daily buys, with the trades you take, where you miss a lot of moves, where one week it feels like you've mastered the market, the next week it feels like you've forgotten how to trade and every move passes you by. Now me and MMT students, we've also been there. Now ask yourself, why do you struggle with consistency? Because you don't know what is consistently expected from you. It's not that hard to have a consistent routine whilst brushing your teeth, because you know it's expected from me before I go to bed, after I wake up again, it's when I brush my teeth. So some questions in your trading, you can ask yourself, what are you exactly waiting for? Where is your area to take a trade? And what is your objective daily bias? And if you can't answer these questions, then you can't be consistent because you're always going to do something else. Now, of course, I have the answer for you. In this video, I'm going to give you the answer. And the answer is quite simple. It is universally agreed upon, no matter how you trade, that you're going to be trading in between PD rates. That is the answer to the 3 questions. But before we dive into that, what exactly that means, I first want to go over a couple of other things as well. Because to tie into that very nicely, we need to understand which instruments, which asset classes you are actually trading. Because it's very important if you trade, for example, futures, Forex, yes, you're going to be trading in between PD rates, but you want to play to the strengths of a certain trading plan, to the strengths of a certain instrument that you're trading. So what does that exactly mean? Because that sounds quite vague. I used to play professional basketball. The only reason why I used to play professional basketball, I was horrible. I was a horrible defender. I was not great at defending at all. But I could shoot that ball exceptionally well. I was so extremely good at that. So the only reason why I played at a high level is because I played to the strengths. I played to my strengths. I kept focusing on getting better at shooting that basketball over and over and over. Now imagine if I didn't do that. If I didn't focus on getting even better at shooting the basketball, even though I was already quite good. And instead, I might have focused on improving my weaknesses or trying to fix my weaknesses. So trying to become a little bit of a better defender. Now I would have become a better defender, but it was still a weakness. So I became an average defender, and because I didn't focus on the thing that was my strengths, shooting the ball over and over and over, that would have become average as well. So now I'm just an average person. So if you compare it to my teammates, I would have been arguably quite similar. Whereas the only edge that I had over my teammates is I can shoot that ball better than you can. So I focused on my strengths, and that allowed me to eventually play at a high level. Now in sports in general, you'll see this a lot as well, but this is the same in trading. So for example, this really comes down to understanding the strengths and the weaknesses of certain instruments that you are trading. If you trade mainly ES, NASDAQ, the indices right there, then the way you are going to trade them is so completely different, for example, compared to a Forex. Why? Because the underlying asset that you are trading is just completely different. If we take a look at an ES, for example, ES and the indices, they run. So oftentimes you're already working with a predefined bias. And most of the time that is going to be continuing higher. Because at the end of the day, you're just trading stocks. And stocks, oftentimes, of course, that doesn't mean that's always the case. But there's a higher probability in stocks over the long term that they are going to continue higher compared to continue lower. So because you're working with a predefined bias, it's likely that you're already going to focus on bias a lot more as well. It's just a higher probability thing to do. Now, on top of that, even if the buys don't play out, and for example, for a couple of months, we focus on short right there, because that's what the market tells us to do, then you will notice it runs. It just runs. So the indices, the reason why indices are so interesting to trade, for example, for scalpers, lower time frame traders, is because they have consistent volatility. They are very volatile, but also very consistent in its volatility. So for example, a Bitcoin, a crypto, is also regarded as extremely volatile. I agree with that, yes, but not consistently volatile. So for example, what you'll see with a Bitcoin, we consolidate for a very long period of time, and then there's 1 week where all of a sudden we have a lot of volatility in the market. So you're going to be waiting a lot before we do anything. It's not consistently volatile like the indices. So what is the strength of, for example, trading an instrument like ES or NASDAQ? Is that it runs. It keeps running. It keeps continuing higher. And to fully drive that point home, if you then compare it, for example, to Forex, Forex is completely different. If you take a look at a euro US dollar here, and we zoom out to the weekly time frame, I don't think I really have to explain this, right? Look at this. What is this barcode price action? Where yes, on euro US dollar, we also, at the start of the year right there, we see a move higher. But what is the underlying factor right here that moves your US dollar? It's economies. So you're trading the euro, Europe, against US dollar, against the US economy. Those economies changes quite a lot. Unless you have a first world country and you compare the currency of the first world country to a third world country. Other than that, comparing first world currencies, the economies are going to change a lot. So they're going to outcompete each other a lot as well. So you will notice you're working less with a predefined bias. It changes a lot more in comparison to, for example, an ES, a NASDAQ. So where we do, of course, with Forex as well, we do have moments where we run lower, where we run higher, but these moves are significantly smaller than what we see on an ES and NASDAQ. Those moves on NASDAQ and ES are significantly larger. And what we see as well is that, for example, on a Forex, we just consolidate a lot more. So we don't really move anywhere for a long period of time. And that is across the board. That is, well, especially true once you start diving into the indices right there. We see a lot. So what is the point? So what is the point I'm trying to make? You approach it very differently. So if you, for example, focus with an ES or NASDAQ approach where you expect price to run, to continue higher and to keep running higher, and you take that trading plan, that approach, and you apply it to Euro US dollar, that's not going to work. Because now you're focusing on the weaknesses on Euro US dollar. Because the weakness is that running part. There is no predefined bias. Now the strength is for example, if you focus on a Euro US dollar, a lot of times on a Euro US dollar, we will just have one simple PD rate that swing high, for example, and we sweep it and we completely reverse. And then we have all of a sudden this fair value area right there that we sting back into, and we completely create a reversal from that. And that, of course, then also creates that more consolidating price action. And again, with the indices, that's just less the case. And of course, don't get me wrong, we will have consolidating times on an ES and NASDAQ, but you will notice the moment we start reaching these bearish PD rates right there, we tend to just disrespect them and continue higher and keep running higher right there, because that's the strength of an ES. Now moving on to the next part and returning a little bit to what we mentioned as well, because the way you approach this is across the board, it is the same. Trading indices, trading Forex, you're always going to be trading in between PD rates. I'm going to explain what that means. Then I'm also going to show you how that then applies to, for example, an ES, the indices compared to a Forex. When it comes to knowing your daily buys and knowing the area where you want to take a trade, it is important to understand that you don't need a large area. You need a very small area. Again, a lot of people think that you need to consistently know what is going to happen in every single daily candle. If you have a complete week, a week of 5 business days, then the urge oftentimes is to guess and see, can you guess all the 5 business days? So can you guess all the price action? If you just focus within those 5 business days that week, can you simply guess 1 business day correctly? And can you do that extremely well? Again, focusing on our strengths. And if you can get very good at that one thing, there's an edge there. So oftentimes trying to profit from everything leads to profiting from nothing. But then we need to understand, where do even these small areas, where do they exactly happen? Where do they show up? We need to dissect the sentence trading in between PD rates. First, let's take PD rates right there. So the PD rates that we're going to focus on, these are the support and resistance levels, essentially a fancy name for it, is fair value gaps and swing points. So to quickly recap that, again, swing points are these, right? This is a swing high right there, and this is a swing low, that 3 candle pattern. Fair value gap is also a 3 candle pattern, but these gaps, those bodies of the candles that we see, for example, right here, also a fair value gap. Those are the ones that we are going to focus on these different time frames. And more specifically, we're going to focus on trading in between them. So how do we even trade in between them? How does that even make sense? Again, what you'll notice that oftentimes, if I mark out, for example, this bearish daily fair value gap, and I mark out this swing high right there, where do these rejections right there, where do we create those retracements to then continue higher again? It comes from these PD rates. Now, why do we continue higher at this moment in time? Because at that moment in time, we had to sting back into this bullish PD rate right there. Now, again, this won't be 100% of the time guaranteed. Again, everything we do is probabilities, right? I need you to understand that. But what we're doing right here is we're stacking up the probabilities. So we're making a scenario where we don't really know what to do. We're making it a very high probability. So what you see right here is that oftentimes when we create a rejection, it is also from a certain PD rate, like the fair value gap and like the swing high that we have right there. So if we know that, then we also know that oftentimes when we continue lower, it is also because of a PD rate. For example, that swing high right there where we create a large rejection. or we create a large rejection to continue higher again from that weekly fair value gap. I think you get the point. But then the areas where we don't continue lower from this premium array right there, and then we have the next premium array, which might be that high right there, that is where an area of opportunity is. So for example, so to draw this first with just a couple of lines, imagine this to be a bearish fair value gap that we might want to continue lower from right there. And this above right there is a swing high that we can also continue lower from. So price might do something like this. We might first trade back into the bearish fair value gap, try to push lower from it. If we don't continue lower from that PD array, and there's no other PD array in between this fair value gap right there and that next swing high right there, then what tends to happen is that if we now continue higher right here, okay, this is where price is free to move because there's no other PD array that can push price lower at that moment in time until we reach this swing high. So this is where we can now create a large rejection potentially to continue lower from again. And if it's not this one, then it might be the next one above it right here. This is in the MMT what we call as well. You want to focus on what is the thing that is preventing us from continuing higher. So if you have been here for an extremely long time, thank you first of all. But on top of that, you'll most likely know that we tend to focus a lot on, okay, what is the thing that is going to push us higher? So for example, the fair value gap right there, we can push higher from that. So if we are going higher, what can we continue higher from? And that's where you get, for example, a bullish fair value gap. Now, what if I tell you that, for example, if we focus on this weekly fair value gap right there, we understand we can continue higher from that, yes. But if we focus on the daily time frame right here, we still have this daily bearish fair value gap. So we are conflicting with one another. So we have this bullish fair value gap we can continue higher from, but this bearish daily fair value gap, that's preventing us from continuing higher at that moment in time. And as long as we have something that is preventing us from continuing higher, well, then we're going to struggle to continue higher. That is where we create these consolidations. That is what we call a 50-50 area where we're trapped in between two PD arrays. Now, why is this important to understand? I want to ramble on a little bit about it, but with important information. Because right here, what you'll notice is that we trade back into the fair value gap right there and we consolidate. And we consolidate, and then after we start to continue higher. We start to continue higher smoothly the moment we overtake. So the bearish fair value gap is not preventing us from continuing lower anymore. So there's multiple scenarios. Let's say we get a retracement right here and we get something that we can continue higher from, but also something that's preventing us from continuing higher. This might create a consolidation to then continue higher. If this is the area that we can continue higher from, this is the area that is preventing us from continuing higher. So if you take a trade early on right here, what does that lead to? That leads to a loss before we now start to continue higher. Now, if we draw another scenario, and let's say we have something like this. We don't consolidate, but we just continue lower. So for example, the thing that we can continue higher from right there, we get a rejection from it, but the thing preventing us from continuing higher pushes price lower like that. So for example, if you take another trade right here, what does that lead to? Well, that leads to a loss. And there's multiple scenarios of what can happen right there. But now let's assume the following, that we do continue higher and we do something like this right here, where we continue higher from this bullish fair value gap, and the thing that's preventing us from continuing higher has been overtaken. And now if you take that same trade, that would have been a winner right there to continue higher. Now, what do all these examples have in common? So how can you stay arguably ahead of the curve? Well, if you wait for us to overtake the thing that is preventing us from continuing higher right there, then you take one winner and you prevent two losses right there, instead of taking two losses and a winner, which leaves you at break even if you target a 1 to 2 RR. So that way, you now nullify the effect that the thing preventing us from continuing higher has on your trading plan. So you completely take that away. So you avoid these losses, but you only add the extra winners right there. That is a really good ROI. That's really good. So here we have this weekly fair value gap that we can continue higher from. But as long as this bearish daily fair value gap is still there, preventing us from continuing higher, because that is what we can potentially push lower from, like we see right there, it's where we can create a rejection. And as long as we have that, we will struggle right here. Or let me give you another example a little bit later on. Right here, we have this daily fair value gap right there as well. That is, again, what we can continue higher from. Now, if you were to go into, let's say, the 15-minute time frame at that moment in time, a trade ID might be something, let's say, like that. Just an example, right? Trade ID might be something like that, or it might be something like this right there. It doesn't really matter. Both potentially hit stop loss. The only place where we now start running freely is, you guessed it, when we overtake the thing that is preventing us from continuing higher, which is this fair value gap at that moment in time. Once we overtake that, that is where we start running higher right here. So I want to tell you a little bit about my story and my experience with this as well. Because one of the first things I did a study on, I learned about these fair value gaps, what they are, etc. One of the first things I studied is, where do these fair value gaps actually hold? So I get, for example, oftentimes I get the question as well, hey Arjo, can you check the past week on an ES because the 4-hour fair value gap didn't hold? What am I supposed to do with that information? In all honesty, what am I supposed to do with that information? There's so much context going into a fair value gap. And one of the most important context that goes into a fair value gap is the context area. That's it, is the area where a fair value gap is likely going to hold. So for example, why does this fair value gap here not hold and create a new fair value gap? Why wouldn't I trade from this fair value gap? Is because we have something preventing us from continuing higher. But as long as this area right there, that fair value gap is now taken away, and we start running right there, and then here towards the next area, that is where it is now very interesting to get involved. This is where we will start to run. And this is so important because that is the context area. That is where the entries on the lower time frame will hold. These fair value gaps on the lower time frame will hold. Again, is that guaranteed? No, nothing is guaranteed. Again, it's all probabilities, but the probabilities of those fair value gaps holding on the lower time frame at that moment in time, that is higher probability. Again, think of why that is, right? Because if we don't continue lower from this fair value gap right there, and we know, well, these PDAs, they are the likely cause that we continue lower from them, or when we continue higher, we also likely continue higher from this counter base. Then at this moment in time, when we don't have this fair value gap anymore that's bothering us, not preventing us from continuing higher, we can continue higher towards this next high right there. And if this is not bothering us from continuing high anymore, we can run towards the next highs. And it continues and continues and continues. Now you'll notice a key difference here between the indices and also Forex. Because when you're working, and again, the strength of the indices is that you're already going to have most of the time a predefined bias. So if we run, we absolutely take off and we continue higher right there. That's also a sign of a very healthy trend when we just continue higher with no looking back. So oftentimes when we reach these next PDAs, we don't even create a rejection, or at least not a large one. We just keep running and running and running. So this is why oftentimes when we disrespect the first bearish value gap that we have going against us right there, we just keep running towards the highs, and the next all-time high is oftentimes the target. The same thing right here. When we started disrespecting this monthly fair value gap, which we already had signs from, because we had such an extremely long wick at the bottom right there. And the moment we start disrespecting it, the next all-time high is just a very clear target. And the reason why is because you're always working with a predefined bias. So on the indices, that's very simply said, look for another reason to buy. And if it gives you that tiny, minuscule, micro reason to buy again, it's likely that we're going to reach a new all-time high. Whereas with Forex, you can't say the same. So again, what is this consolidation? A consolidation, it's important to understand at every single moment in time when we reach a certain PDA, you have a chance of a reversal. So even if the indices are potentially consolidating at a certain moment, this is also important to understand, to know how to navigate your way in certain consolidations. So for example, when we know that at every single PDA, the chance of reversing and creating complete reverse to continue lower again, and here reaching a discount rate to create a complete reverse to continue higher again, what is important at that moment in time is that it's even more important to understand trading in between PDAs. Why? Because we need to know when we disrespect, for example, these highs to continue higher towards these next highs, to actually start continuing higher towards these next highs right there. And once we understand that, we can really well understand the moment we disrespect this PDA right there, we can now continue higher towards the next high. That is again where we're trading in between PDAs. But as long as we are respecting this PDA right there, well, we might want to look to trade towards this next low right there instead. And potentially then towards this next low. So how do we know that? Again, then we need to take a step back a little bit, because then we need to move on to disrespect and respect. Because you've already heard me talk as well. We are disrespecting this fair value gap, or disrespecting this PDA, or we are overtaking it. That's the same thing. But the way we go about that is quite important to understand. Listen, I first need you to understand every single PDA that we have on our chart, every single PDA that you can think of. And if we just stick for now to fair value gaps and also swing points right there. So swing highs and fair value gaps in this case. They're only valid once. So please, if you want to, I want to ramble on a little bit about this as well, because this is very interesting. And I think you should absolutely understand it for your trading. Most people think that the way you increase your accuracy is by adding more things. So for example, the more PDAs you add on your chart, the more reason you always have to do something. So you can always argue, oh, it's rejecting from this random new PDA. But wouldn't you argue, and think logically along with me here, wouldn't you argue that the more things you add on your chart, the less accurate something is going to be? So wouldn't you think that because new PDAs get added, all these random lines get added, is because you can't accurately make the simple PDAs work? So oftentimes, in my opinion, it's a coping mechanism, because you can't have that 100% win rate. And so new PDAs need to be added to always make sense of what is happening at that moment in time. You can't simply accept the fact that it's just all probabilities. So for example, if you now start adding 50% level right there towards your fair value gap, if you start adding 100% level at your fair value gap, there's no substance to that. Zero substance. And all it does is give you an extra reason that price can do something else. So you have all these different reasons, which in turn then decreases your accuracy. So a very good example I always like to do, again, I can draw a random straight line right here on Euro US dollar. And I can do that a whole lot. And the more lines I draw right there, well, the more I'm going to have. Look, we are rejecting right there from that line. Look at this. Perfect resistance right there from that line. Perfect resistance right here. Now we're overtaking it. Again, the more lines I add right here, the more random it is going to be. But because you have all these lines, we are bound to sooner or later reject from something. Like a broken clock is right twice a day. True accuracy, in my opinion, comes from having just 2 or 3 PDAs on your chart and knowing exactly what we can do at that moment in time based on those PDAs. And that's it. So not having all these random levels. And the reason why that is, again, important to understand is if we have this fair value gap, if we have that swing point, they're valid one single time. No more, no less. So we can trade back into that fair value gap right there one single time and potentially continue lower from it. If we don't continue lower from that fair value gap, it's likely because of another PDA, so a swing point. So a good practice that you can start doing is start marking out all these PDAs. For example, we reject from that fair value gap. We reject here to continue lower from this swing high. We reject here in the short term from this swing low right there at this moment in time. Here we continue higher from this swing low right there. And then you'll see how accurate just these 2 PDAs, fair value gaps and swing points, are. Now on top of that, the reason why this is important to understand to remain this accuracy is for the next part in the story right here. So fair value gaps, you might be familiar with it, they lead to candle signs. So what does that mean? Again, every single fair value gap that you see right here on these different time frames, we have all these bullish fair value gaps right here continuing higher. If these fair value gaps help us in understanding the direction, so if we continue higher, well, in hindsight, we clearly see that creates bullish fair value gaps, right? So oftentimes we follow the most recent fair value gaps. When we create bullish fair value gaps right there, we follow through and we create more bullish fair value gaps. So we follow the recent fair value gaps. If that's true, and it tells direction, then not only these 4-hour fair value gaps, but then also singular candles tell us the direction. Why? Because think about it. What is this candle right here on the lower time frame made up of? If we take a look at this candle right here, that candle on the lower time frame is made up of all these different fair value gaps right here. And in this case, more bullish fair value gaps than bearish fair value gaps. So if we understand that, we need to understand that we have 2 types of candles again. Respect candle and disrespect candle. So what is a respect candle? A respect candle oftentimes is, well, like it says, it's already respecting something, right? So it's respecting a PDA right here. And when we see a respect candle right there, the reason why it's a respect candle is because it's a long wick right there. We call this long wick respect or a large rejection at that moment in time. So for example, if we go into the lower time frame, then what is this singular candle made up of? It's lower time frame fair value gaps, where we first continue lower, creates the bottom part of the wick, and then we continue higher again. And that eventually creates that wick, where we first create bearish fair value gaps and then bullish fair value gaps that create the long wick that you see on the 4-hour time frame. That is a respect candle. Now that's important to understand. On top of that, we also have disrespect candles. Disrespect candles don't have these long wicks. So they're more so large bodies like this one and like this one as well. Now what you'll notice if we go down time frames in these large bodies, it's just fair value gaps moving towards one direction. So right here, we can understand what the next candle likely wants to do based on the previous candle. For example, if we have a large respect candle like this respect candle on the lower time frame again was bullish fair value gaps moving higher and then bearish fair value gaps right there. That means that we are creating a reversal right there on the lower time frame. But if the next candle is this disrespect candle right there with these large bodies just moving towards one direction, then that means we just have these bearish fair value gaps being respected to continue lower. So we continue in the direction of the respect and we continue in the direction of the disrespect. Here we can continue lower right there towards this low. Now we see we respect this low. We can continue higher in the next candle, potentially towards this fair value gap. And what this all leads to is a very interesting story. Because based on respect and disrespect, you'll know again that respect and disrespect is based a lot on these PDWAs. So we're respecting or disrespecting PDWAs. That's why it's called respect or disrespect. So here, for example, we are respecting this swing high, we are respecting this swing low, and we are potentially respecting right there this bearish fair value gap as well. Then what is a trend? Then what is a trend at its core? What makes us move higher? What makes price move lower? And what makes a consolidation? A consolidation, like we mentioned on Euro US dollar, for example, that is where price is respecting PDWAs on both sides. So for example, price is respecting these swing highs, but also these swing lows right there. It's not clear. So in order to have a trend, what do we need to do in order to have a trend? Well, at its most basic form, a trend is us respecting certain PDWAs and disrespecting other PDWAs. So what does that mean? Discount arrays are bullish PDWAs. So a bullish fair value gap is what we call a discount array. A bearish fair value gap is what we call a premium array. So when we are creating a bullish trend, what does that look like? That means we are disrespecting premium arrays and we are respecting discount arrays. That makes us move higher. So think about it, right? Because one side of the market always needs to be weaker. In order for us to move somewhere, one side of the market always needs to be weaker. Again, I love this tug of rope analogy. And you really need to ingrain this into your mind. Tug of rope, I mean the tug of war. So if you have that rope that two teams are pulling on, and then you have the bearish team and you have the bullish team. If both sides are equally as strong, the middle of the rope is not going anywhere. So no one is going to win. So one team needs to be stronger than the other side to actually create some momentum and for the other team to win. So if the bullish side wins, then that is reflected as disrespected premium arrays and respected discount arrays. So for example, right here, we keep disrespecting these premium arrays and we keep respecting these discount arrays right there. And if we continuously keep doing that over and over, we can arguably say right here, well, this trend is bullish. The opposite is also true. So for example, right here, the moment we started continuing lower, we started disrespecting discount arrays right there, and we started respecting these premium arrays. And what that leads to is a bearish trend. Now, again, why is all of this important to understand? And why does this disrespect and respect then, again, lead to a certain trend? So what even is the respect and disrespect? Okay, it's going to make sense. Stick with me. Respect and disrespect, so respecting and disrespecting PDWAs. If we are respecting or disrespecting PDWAs, that's based on candle signs, the candles we just learned about, those two candles. But it's more so based on two candle rejection. So it's this whole inception of things. And to say, Arjo, where are you pulling these concepts from? This is years of work. This is years of studying the market. And I started off with just simple fair value gaps. That simple fair value gaps allowed me to understand what one singular candle is doing. Based on that singular candle, we can understand the next candle signs. Based on that candle signs, we can then understand two candle rejection as well. So oftentimes what you'll notice is that we have two chances to create a rejection from a PDWA. That's hence the name two candle rejection. And I'll explain the rules. If the first candle is a respect candle, so is a rejection from the PDWA, like we see, for example, right here, then the second candle can simply follow through lower. And once that is in motion, once that is happening, as long as we are still having this respect candle right there, we are respecting this PDWA. The same way, if we have this swing low right there, the first candle is a respect candle, is a rejection candle right there. And the first candle is a rejection. The second candle can simply continue higher. That's if the first candle is a rejection. Oftentimes, you will also notice that if we, for example, have this fair value gap right there, and the first candle is not a rejection right here, or at least not as long as a wick as we see right there, then we can still, in the worst case scenario, sweep this previous candle low to then continue higher from it. So again, what that means, the first candle or the second candle is going to be a rejection. So if the first candle is already a rejection, like we see, for example, here, or you could also take the fair value gap right there, with a long wick, second candle can simply continue higher. And we are respecting at that moment in time the PD rates that we have. But if the first candle, for example, from this bearish fair value gap, is not a rejection, like we see right here, then the second candle can now become that rejection candle, can become that respect candle by sweeping the previous candle high to then potentially continue lower. So what does that mean? That means that either the first candle or the second candle is going to create what we call a rejection low or high. So for example, here from this swing high, this right here is then the rejection high. That's the rejection candle because the first candle is the rejection candle. So this is the rejection high. From this fair value gap, for example, the second candle is actually the rejection. So that is the rejection low right there. Or from these swing lows right here, then this is first candle as well. So that is the rejection low. From this bearish fair value gap, the first candle is also a rejection. So this is the rejection high. Okay, so let's just keep for now this rejection high and this rejection low right there on our chart. Because what are we currently looking at? Well, currently we are respecting a discount array right here, but we are also respecting this premium array right there based on the two candle rejection that we have. So this is where it gets very interesting because at some point in your trading, once you start understanding this, it all just becomes a simple parameters game. And what I mean by that is if this happens, you do this. If this happens, I do this. So we need to understand two candle rejection again. If this is a respect candle, then what in theory should the next candle do? Should follow through lower like this. If this is also a respect candle, then well, exactly what we're seeing right here, we should continue higher on this next candle. But we should not run this rejection low or run this rejection high right there. So if we start running this rejection low right there, then what happens is that we now have a clear path to continue lower towards the next discount rate because we are disrespecting this discount rate right here in the form of that swing low. But if the opposite happens, if we now start reaching above this rejection high right there, we are disrespecting this bearish fair value gap, the premium rate. So that means that we can now move clearly towards the next PD rate and potentially towards these next PD rates right there as well. Where this area, what we talked about at the start, that is that area where price is now free to move because there's no other PD rate that is stopping us right there. So we need to know if we are running this rejection high or are we running this rejection low to then that in turn leads to us disrespecting either this discount rate or disrespecting this premium rate, which then leads us to freely move again. So how do we know that? Well, if we look at the next candle right here, again, this candle was a large respect candle, right? So the next candle should continue lower. Or in the worst case, it could still sweep the previous candle higher right there to then continue lower. Well, if we show the next candle right there, that didn't happen. This is where we now want to go down time frames a little bit because that rejection high, what is that? What does that turn into? If we go into the 50-minute right here, it turns into a swing high. So it's just another PD rate, right? It's all fractal. If you start understanding these time frames, that's why I think understanding these time frames is like a skill in itself. Because once you start understanding the time frames, you can combine them very creatively. Because that rejection high on the 4-hour right here, the same rejection high on the 50-minute, but it just turns into a swing high. So if we want to now see us run this rejection high, what is running that rejection high? Is disrespecting that swing high, disrespecting that premium rate. So how do we know if we're disrespecting or respecting that PD rate? Two candle rejection. It's the same thing all over again. So for example, right here, we go into the 50-minute, understand the first candle is not a rejection right here. So the second candle can sweep that previous candle high. And now the third candle, we should just follow through to respect this swing high. If that doesn't happen, this third candle now starts to continue higher right here. Then what happens? Well, we can assume that we are disrespecting this swing high because two candle rejection is failing. So here, this in itself, since we are now disrespecting this swing high, stick with me, we are running that rejection high, right? So that means that we are disrespecting this premium array that we have right there. And because we are disrespecting this premium array, and we're not going to continue lower from that premium array anymore, then we could assume, well, we might want to continue lower from this one. So this area is that area of opportunity right there. So that right there is where price is free to run right here in the short term. And the same thing happens, price free to run, once we start disrespecting this next high. Free to run right there again. So how do you capitalize on this? Well, once the 2 candle rejection right here starts failing, and you look for an entry like this, for example, to cover, in the worst case, if we do get a retracement back to the fair value gap to then continue higher, and this is going to be your entry. It's all fun and games, Arjo, but this is a lot to apply, of course, and there's no way you would have caught this in real time. Yes, this exact trade, this is just a trade breakdown. So this is the exact trade that I took. And the only reason why I was able to take the trade right there is because in my trading plan, also previously, I have been struggling with missing a lot of trades. And missing a lot of trades, I thought the problem was I'm not focused enough. I need to pay more attention. So what I did is I tried to pay more attention. I don't know, burn my eyes harder or something. Like, how does that even work? But again, that was not the real problem. That was a symptom of the problem. So the symptom was I'm missing move. The real problem was I don't know exactly what I'm waiting for. So I can't be consistent. Again, how can you ever be consistent if you don't know what is consistently expected from you? Especially in the trading, because no one is going to tell you where to look to get involved. And if you do, it's probably signals and it's shit anyway. So you have to know for yourself what is expected of me. Where am I going to look to trade? Now, once you start understanding this area, again, the video is not over yet because I understand this might be quite overwhelming, might be a little bit difficult to understand. But once you start understanding this area, it becomes very straightforward. So for example, right here, remember what we talked about on an ES and the indices in general, that they have a predefined bias. So once you have this resistance is what we call it right here against us, this bearish fair value gap. Why is that resistance? Again, what is a resistance? Resistance is an opposing PDWA. Why is it an opposing PDWA? What makes it an opposing PDWA? It's a PDWA that goes against us. So why is it going against us? Because we have a bullish bias at that moment in time. So we expect ES right here to sooner or later reach a new all-time high. This is why we're working with a predefined bias. So when we have a predefined bias right here, we understand, hey, this bearish fair value gap is not in line with our predefined bias because we are expecting higher prices, but now we are continuing lower and creating a bearish fair value gap. So what should we do? Well, we have this bearish fair value gap, which is not a problem because that is the thing that is now preventing us from continuing higher. So if that thing is not preventing us from continuing higher anymore, then we have all the reason to continue higher, right? That makes logical sense, right? So then how do we know if that thing is not preventing us from continuing higher anymore if 2 candle rejection is failing? And that's where we now start to introduce and again, make you familiar with all these rules. Because if 2 candle rejection is failing, and that means we are not respecting this value gap anymore. And because we only use it one time, it's disrespected. We can't continue lower from it anymore. So if we are going to continue lower, it's from either this swing high or from that swing high. But since we have a predefined bias towards the all-time high, it's most likely going to be this all-time high right there. So this is a full area where you can look to get involved to continue higher. And that is exactly why on ES, very similar, I also took this exact same trade. And again, I'm not here to brag, oh, I took those trades, haha, in your face. No, it's purely to show you, again, you can only take those trades if you know exactly what you're waiting for. It's not subjective. I woke up today, I drank a good coffee, I feel good today, so I think I'm going to take this trade. It's objective. So I know exactly if I've also missed trades, because I know if I didn't catch the trade, I would have missed the trade right there, of course. But that means that right there, that is my area. I need to get involved. So I know exactly what I'm waiting for. And for an ES, a NASDAQ, and the indices, and for example, also with a gold right there, because you're working with a very predefined bias, so I'm looking at stocks, if we can overtake those areas, for example, in NVIDIA right here, I also caught this move right here to continue higher. Beautiful move. And the sole reason why I caught this is because we started running this high, disrespecting that pre-rate right there, nothing preventing us anymore from continuing higher. So we were free to move. Now, if you take a look at Forex, this is the same thing, right? The same exact thing, trading in between PDWA. So if we take a look at the 4 hour, I really like to use the 4 hour on Forex right here as well. For example, we have this fair value gap right there. And all you need to do at this moment in time is start marking out these areas. Start understanding that, start understanding the language. If we start disrespecting this PDWA right there by running this rejection high, we have a clear move towards these next highs right there. Okay, this is where we can now create a rejection. And again, this is Forex. So the rejections are likely going to be, well, bigger. They're going to be seen better, if that makes sense. because at every single period, we could potentially create a reversal. Now, at this moment in time right here, again, we also have this bullish fair value gap, right? That we could potentially continue higher from, but it's a period. So if we disrespect this period by running this rejection low, then we could continue lower. But you'll see right here, instead, we start running this high right there, that rejection high, to now continue higher towards these next targets right there. Now, of course, if we start running this rejection high, could you get involved in that tiny area? Well, most likely not, right? But the same thing, now we create this rejection high from the previous swing highs that we had right there. So here, same thing. Okay, we also have this bullish fair value gap. Can we now start to run this rejection low right here or run that rejection high? Now, oftentimes you'll look at this on the same time frame. That's also what I would advise to start off with. Start looking at this on the same time frame. And then slowly you'll get a better understanding of what we're looking at, where you can actually dive into the lower time frame, like I also do, to then understand, okay, I'm going to use the lower time frame to start looking, for example, for bullish fair value gaps right here to get involved to continue higher. So this is where it's now interesting to target these next highs right there, where you can get involved in these candles right here. So going into the lower time frame. Now the same thing, once we start reaching this high and we are respecting it, okay, and let me remove everything that happened right there. And the moment we start disrespecting it is right here by running this rejection low right there to run towards these fair value gaps that we have. But the same thing, if we disrespect these fair value gaps, we're going to run towards these lows. The same thing right here, if we now look at this low right here, and we have this swing low, which is that rejection low, then here we have this next swing low that could be the target. And now here you have a very large area the moment we start running, disrespecting and running that rejection low towards the next low right there. Which is where on the 1 hour, that is a beautiful move to be a part of right there, to continue lower. And again, these moves, you realistically only need one of these high probability moves a week. You don't need to catch them every single day, but that trading in between periods, that's again universally agreed upon. It happens everywhere. So the best thing you can start doing right here is please do yourself a favor, because I know how many people watch this video, basically don't really watch it, more treat it like a Netflix. I know how many people then don't take notes. I know how many people don't do their own case study. Again, I can tell you all these beautiful things that work, but it's never going to work if you don't put in the work yourself. So I really need you to understand that. Again, the biggest advice I can give you is, yes, everything that I've mentioned, but then please go into your own trading view, start marking out these areas, start seeing it for yourself. And when you start seeing it for yourself, it will slowly start to begin to click. All right, perfect. Thank you.